Hello and welcome to today's Silver Log. It is Sunday, the 26th of June, 2011. And before we get started looking at many different markets, I want to show your buying power in two different asset classes. One in fiat cash and two in silver. Now, you know which one is in silver, you know which one is in fiat cash, but you don't know what the numbers represent. Well, I'll help you and I'll tell you. On the left-hand side, this signifies how many rides you can get on the New York Transit system with 20 fiat dollars, or a $20 bill. In 1968, you could go on the subway about 100 times with $20. Today, that number is under 10. So therefore, it has lost more than 90% of its value, priced this way, than just fiat cash. One of many different items that have inflated large over this period of time. Now, as far as silver is concerned, or the price of it in silver, with an ounce of silver in 1968, you can get yourself on the subway or on the transit system 10 times. Then when silver peaked, you could have done it 100 times, back down to 2.25, and now today at around 15. Since 1968, you have actually increased your buying power on silver, where with fiat cash, you've kind of lost it just a little bit. Alright, let's get started. Let's take a look at some different markets. They're all going to have the same format, and that there will be 100 candles. The blue lines will represent the 18-period averages. The top one is that of the 18 average of of highs, closes, and lows. This line here represents the 41-week average. Why 41? Because in my opinion, that best describes a 200-day moving average. 40 times 5 is 200, and well, I guess I could use 40. However, in my opinion, in the average 41 weeks, I would expect 5 days to be a holiday, thus a more accurate movement of the 200-day moving average. And these homemade bars or bands, sort of like Bollinger Bands. Let's get started within today's analyses now. With silver, as it was moving into last year with this rising 200-day moving average, it was bullish, or at least trying to remain bullish above this 200-day moving average, above the 18, but not able to reach the upper band. Find support for a long time. There's no such thing as going up for too long, down for too long, or sideways for too long. And since then, now it's been finding support in here. I've been stating that this was cautiously bullish because it is above the rising 18-period average. That has now come to a conclusion. The market has now went neutral. For example, in here it got cautiously bullish, and then there was this nice little bear trap. That's something you got to watch on many of occasions. They happen quite frequently. You get a little trap in the opposite direction, and then boom. Now, the failed move didn't come until later on, but it did not head lower after breaking below this period, not finding resistance in here. I got many different charts I want to go over, so I want to make this fairly quick. The next one is gold, and gold's been like gold, and I know that doesn't sound right, but gold for the last 10 years has been pretty much in an upward trend, not really breaking the support line, and really not breaking the resistance line too much. This is only a year or so. But if you look at the 10-year chart of gold, you would see the same sort of thing. So it's in this line, it's in a sideways consolidation, but it's upward because the uptrend line is moving. It hasn't been often that the market has went below this 18-period average of lows. And here, brief period in here, brief period in here, again briefly in here, and that's it. So the market's been remaining bullish. It has not even touched the 200-day moving average within this time frame. Does it need to at some point? Yes, but there's no need for it to happen now, although it could. Doesn't have to. Next one will be platinum, and there's no palladium for this one. I'll be doing a separate palladium video later this week. But as far as platinum is concerned, support found earlier this last year at this 200-day moving average. It lifted higher, found support again here, and now starting to break below this level. The 18-period average is starting to roll over as well. You can make a case of maybe even a triple top. Market not able to get above the significant resistance level at roughly about 1860. And now moving down towards this significant Fibonacci level at about 1575. It's also an area of previous resistance. Will it become support? You'd have to say probable, but not guaranteed. Next chart will be the JJP ETF, and that's the precious metals ETF. I'm not a big fan of ETFs because they're like a casino code, and the whole system to me is like a Ponzi scheme casino. If you choose to play it or you want to try to outsmart it, congratulations and good luck to you, but that's not my style. But it does help track or at least give us visuals for how precious metals are making it. A lot of ETFs overall I don't trust, like USO, UNG. They don't trust the they don't track the ETF currently that well, and I don't even know how well JJP does. But within this, you have a situation of a big high versus a big low, and you're now staying within it, showing all of this indecision. A lot of times after this, you'll get an explosive move either towards the upside, downside, or an explosive range that has some big moves that would say come up to 100, maybe back down to 80, and so on. Usually one of the three happens. What usually does not happen is your everyday regular trading after something like this occurs. It's only been about 7 weeks now, but it has been showing the consolidation that way. Next up, I think, will be copper, and copper on this chart, it's an ETF, but what I really want to focus on is the $4 mark, which is pretty much in here. If you look at a longer term chart, it tried forever, well, for 3 or 4 or 5 years, to get above the $4 mark. It could never close a week above it. It finally did earlier this year. It's now came back to support. This is that textbook situation where you have a big level that's been tested on quite some time. It gets above it, but doesn't break it that large, comes back to the level, and now as it breaking above this level and here could bring some very big gains. But the reason why I say it is oftentimes major resistance becomes major support, and that has now happened. Major resistance has become support. Now the big question is, will it be support for a major leg higher? Usually it does. That, though, is not guaranteed. Next one is the DBB. This is the base metals ETF. Obviously not as strong as the precious metals happen to be. I think all metals are very precious, whether they're precious or base. Look around you, look in your house, look in your apartment, look anywhere you happen to be. See how much metals are used and how important they happen to be. Next up is TAD. This is a solar one. This is like the new energy base. At least that's how I see it. It's newer, cleaner energy. And this market is getting crushed. Totally crushed. Almost as if that we don't care about solar energy. Well, I'm very bullish on solar energy for the long run. Should I be bullish here on the stocks? Well, I don't play the stocks. However, I do realize that it is really getting beaten down large, especially against all the other indices. This thing was about $30 a share before the 2008 crash. Now it's at levels not seen in quite some time. It's now below the 200-day moving average, below the 18, below this lower Fibonacci level. It has been stabilizing in here, but I do find it interesting this to be the case. Not shown on here is DBA. That's the agriculture fund. Don't know why I didn't put that one out, but it's been doing this similar sort of thing as well. BAL is the next one. This is the cotton ETF. That's a lot of people's favorites these days because it's been doing so well. If you look at the volatility in here, you go from about $36 an ounce up to about 120. That's pretty massive, and you've had a consolidation period. Now this Fibonacci is from this low. It's the automated Fibonacci, and it's going to continuously go higher. But if we put the Fibonacci here, it's pretty much now at the 38.2% Fibonacci. In fact, the number would be, and I'm not going to do this, but if you are interested in what the Fibonacci would be, you take 120, that looks like the top, you divide it by the low, which looks to be about 35. 120 divided by 35 to the power of 618, and you multiply that by 35. You should get somewhere around 70. Excuse me, 77. Should get somewhere around 77. I haven't done the calculation. I'm just saying it because usually Fibonacci hits. This is where the hit is, so I'm guessing that's where that number happens to be. Next one is the SGG. SGG stands for the sugar ETF. It's had its situation where it's came back to the Fibonacci from this low and this high, right at this 38.2%, or 6 on the way down, that is. It went below it, which is fine, but it still managed to find support in and around that area, and it has lifted higher. Also, when you go down below a significant moving average, like you can see here, and you don't find resistance, and that can oftentimes mean a fast move. Now, this isn't as big as this one was. You go well below it, and then your fast move. But also, when you take a look at this, look at the consecutive red candles in here. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 consecutive down weeks in a row. Like I say, no such thing as up too much or down too much. Next one will be that of JJG, which is the grains metal. And within this ETF, it's been having its upward gain, consolidating here at 18, but didn't get above this high. Continue consolidating. Now starting to break lower. Market has just started to turn bearish. And as far as Fibonacci is concerned, we're now getting close to the first level, breaking through here. You can take us down to maybe about 41 or so, of course, if it continues to go lower. Grains are definitely needed in this world. Oil is the next one, crude oil. And I was stating in here that all this was a confirmation breakout that the selling in 2008 was a failure. And that all is actually means a lot. Meaning, if this is a failed move on a confirmation breakout, that's huge. The last time I seen that was in silver at the end of April, and that only resulted in a 35% collapse when it had a failed confirmation of going parabolic. This has got a confirmation of breaking the selling of 2008. However, we're now at the former resistance as a level of support. It's at the 200-day moving average, an area where you are likely to find support. And then again, when you're at support, it can be both bullish and bearish. A situation where it's bearish is if you find support, come up to this previous level of support or towards this 18-period average, which would be flattening out, then use that as resistance, and then break below. There's your bearish side. On a bullish side, then that would be the bottom of the market and start to go higher. The next one is the real estate. Real estate, which is the IYR, has been surprisingly holding better than most of the things out there. It's actually still cautiously bullish within this 18-period moving average and above the 200-day moving average. Next one is the stock market, the Dow Jones Industrial Average. The Dow Jones has been finding support in here. It found support again in here. Now this hasn't found support as well. Now trying to find resistance at that level, still above the 200-day moving average. Significant resistance here around 11,120-ish or 125, or wherever these April highs happen to be. Twice that level has been resistance. Will it be support again? I don't know. Next one will be the NASDAQ. See, the Dow Jones hasn't even touched the moving average of the 200, where the NASDAQ's different. The NASDAQ is now testing the 200-day moving average. As far as previous resistance is concerned, I guess you could say right now it's at the previous resistance in here. I guess below that, I don't know, but What I do know is that there's key Fibonacci support at not 24, the line that you see, because this is automated. It's taking Fibonacci from this node, and to me, that doesn't jive well with it. Automation can work great, but sometimes you got to use your perspective and say, what's the deal here? And once again, you do take the high, which would be roughly around 2880. You divide it by, I'm not going to write it down anymore, say 2000, and then you put it to the power of 0.618, multiply that by 2000, and then that should give us a number somewhere in here. And then again, down below in here if it continues to go further. But there's a lot of people getting shaken out of the markets, how much lower these things will go. It's either going to be really reverting the trend to the downside or giving us some major bear traps along the way. After the NASDAQ, we will now do the Dow Jones 20, which is the transportation index, holding very loosely here within this 18-period average. Still above the Bollinger, not the Bollinger Bands. These are my bands that I made, but it's a lot of room for both the upside and the downside. Next one will be the financials, XLF. And this has been the weakest of the group on the financials. Big support isn't even on this list. That is $11.33. But it's been going extremely sideways more than anything. And if you look at this on a logarithmic chart over the last 6 months, this is one heck of a sideways, boring consolidation action on low volume right now. But overall, it's been really choppy. It's in a bull market here. Now it's cautiously bullish. Okay, looks like it's breaking down. Nope, nope, nope. That's why I say these things can either be a big bear trap. You see here, bear trap move, fast move up to resistance, but doesn't find support here where it's supposed to. Instead, it's looking like it's going to break down. Nope, nope, nope. Now we're neutral. Okay, we're bullish again, and now we're neutral. And now again, we're bearish. This thing is a waste of time as far as trading. It is very neutral, and I think is the most corrupt one out there because the financials represents banking system. I'm not a big fan of the banking system, period, because of what they make. What they make is dollars, and this is a dollar index. Dollars are a bunch of fiat notes, money created by governments, practically extremely easy to create, that guarantees debt for its citizens. If you don't understand why it's guaranteed, I would Google search Zeitgeist Federal Reserve, money masters, money as debt. Excuse me, money as debt. It's a very destructive system. But when people figure this out on a larger scale, then hopefully something will be done about it. And as far as this is concerned, I was stating about 80 being a big level of resistance. It would be catastrophic if it was. Well, let's just draw the line of 80 here. There's 80 as resistance. It's been managing to go lower. It's the biggest low is $70.70 or 70.7. That's the all-time low. It's now went below 80. It's consolidating here. I guess you could state that there's some resistance at 78, but it doesn't look good right now for the currency. By the way, this is not in logarithmic movements. All the other ones, except for this one and the next one, are linear, or are logarithmic, sorry. But the next one is bonds, which again, same old stuff. It's the currency. I don't expect this to survive for too long. And it's been obviously in a downtrend. Then it goes higher. Then it goes below this level. Then it goes above it. It goes above and below it. So now it's been above it for quite some time. You gotta think that the trend soon is going to be switching over. If you're playing the game, that doesn't mean you short now, because if anything, it's saying that there's giving you buying opportunities to go higher. Why does it show us this? It's because it's went above this significant Fibonacci level. You have this situation of a double bottom. It's now went above it. It's finding support. And it's looking strong as if it wants to break above this and maybe make it up towards this 100 mark. At that point, I'd be extremely cautious if the market were to be able to get there. Alrighty then, thank you for watching this video and have yourself a magnificent day. Bye-bye.